Hi class. In this video I thought I would look at a few of the problems from Chapter 18's homework. So these are very similar to your homework other than the amounts may be different, but the basic problems should look the same. So in this first one it says Hightower Company acquired an asset on January the 2nd. It cost $166,000, has a useful life of 4 years and a salvage value of $60,000. It says to compute the depreciation expense for each of the first 2 years using the straight line, double declining balance, and the sum of years digits. So let's see. We've got a straight line. I'm not going to actually do the straight line. That's fairly straightforward. Just the cost less the salvage value and then divided by the useful life. I did want to look at the double declining balance method. So in the chart for double declining balance it says beginning book value to be $166,000, and the rate, let's see, I believe, let's see, they're doing this in the straight line method. They're doing the useful life over 4 years, so they are decreasing the value of that asset by 25% each year. So 25% times 4 would be 100%. So they'd be 100% depreciated in 4 years. So if the straight line, or if you want to think about it as the single declining balance method, that would be 25%. So the double declining balance would be twice that, which would be 50%. So our depreciation for the first year is $166,000 times 50%, $83,000. And our accumulated depreciation is the total of the depreciation up to that point, which at this point is only $83,000 because we only did 1 year. Alright, so I would say sometimes these charts aren't really helpful. I guess the beginning book balance at this point is what it is at the beginning of this year. Let's see if that works. Nope. Did I do my math wrong? Oh, it's $83,000. We took half of it away. I just can't add. All right, let me try that again. All right, so our rate is still 50%. If we take 50% of $83,000, would be $41,500. Our accumulated depreciation would be $83,000 from the previous balance plus the $41,500 from this year. Be $124,500. And I want to look at this real quick because this is where the problem comes in. We had a beginning value of our whatever it is we bought. Doesn't really say, does it? This equipment, whatever it is, we bought it for $166,000, and we've now depreciated $124,500 of that. So our balance our book value for our piece of equipment is $41,500. Now this is where the problem is going to come in, because if you check it, it's going to say it's wrong. And it says it's wrong, and there's a reason for that. If you look up in the instructions, it says it has a salvage value of $60,000. So at this point, the company believes, they're guesstimating, that when they get ready to sell this asset or dispose of it, crush it, whatever they do to it, they're going to recover $60,000 worth of the asset. So when we depreciate this asset, we don't want to depreciate that last $60,000 because it's not going to be a cost to us. Because we're going to recover that money. So when we're depreciating this asset, we can only depreciate the $166,000 less $60,000, which we're going to recover. So only $106,000 of this asset is really an expense to us. So let me return to the question. So when you're doing the double declining balance, you kind of have to come at this backwards, so I'm going to erase this. The accumulated depreciation for this asset can only go up to $106,000 because that's the amount that's the expense to us. The other $60,000 we're going to recover. So then you kind of have to back into this. So if we can depreciate a total of $106,000 for that asset, and we've already depreciated $83,000, then at this point we can only depreciate $23,000 more before that $83,000 plus the depreciation for this year comes up to $106,000. So that last year for your double declining balance is basically a plug. It's whatever amount that you need to depreciate to get the accumulated depreciation up to the cost less the salvage value. So that's number 4. Excuse me. Let's look at another one. All right, so a company owns a truck that costs $45,000. Depreciation totaling $29,000 has been taken on the truck. And then we've got 2 assumptions. We're going to sell the truck for about $14,000, and assumption 1, assumption 2, going to sell it for $17,000 some odd. So here we're going to record the sale of the truck at a sales price of $14,210. So I always like to start with what I know. We got cash. That's pretty straightforward. All right, so the next thing we need to do is take off the truck off of our books. So we had a truck that cost $45,000, and we have accumulated depreciation up to that point of $29,000. So those are that's what's on the books. The truck's on the books for $45,000, accumulated depreciation for $29,000. So we need to get that off the books. So we're going to take the truck off. I'm going to skip a line there. Actually, I think I'm going to skip 2 lines. Where's trucks? Going to take the truck off for $45,000, so that's a credit. And we're going to take accumulated depreciation off for the balance in that, which was $29,000. All right, so now we have debits of $14,210 and $29,000. We have debits of $43,210 and a credit of $45,000. So we've got to have $1,790 to bring our debits and credits in balance. So that is just a plug number. You can come at it another way, but I just like to plug it. So that's either a gain or a loss. And in this case, it's actually a loss. If it comes out to be a debit, it's a loss. If it comes out to be a credit, it's a gain. So let's just check my work. All right, so I'm not going to do the next one, but it's the same problem except for you sold it for more money. So you're still getting cash. You've still got to take that truck off. So you're going to credit for the balance in the truck account, debit for the amount in the accumulated depreciation in trucks, and then you've got that 4th account. It's either going to be a gain or a loss. You have to figure it out by figuring out what makes those two the debit and the credit balance, and then plug that amount in and then label it either a gain or a loss. So that's it on that one. Let's go up onto another one. All right. This says on January the 5th, Mountain View Company purchased construction equipment. It's useful life of 8 years, salvage value. They use straight line method to depreciate, and then they traded in for a new similar construction equipment that has a value of $1 million. The company paid $587,000 in cash and were given a trade-in allowance of $413,000 for the old equipment. So let's see if we can figure this one out. All right, so we know we've got to take the old piece of equipment off. So what year are we in? Let's see. Okay, so we're in 2019 now. We started out in 2015. So we've got to figure out how much depreciation they've taken up to this point. So we've got all of 2015, 16, 17, 18, and half of 2019. So they use straight line depreciation, so we're going to take the $904,200, which is what they paid for it, and we're going to subtract from that the salvage value. So we've got a depreciable amount of $811,200. And we're going to divide that by 8 years. So it looks like my depreciation is $101,400. And what did I say? It was 2015, 2016, 2017, 2018, and half of 2019. So 4.5 years of that depreciation rate. Looks like we had, excuse me, accumulated depreciation of $456,300. So we need to take that off of the books. And we might have to move some of this around in a minute. Let me just skip a few lines. And we're going to take the old equipment off of the books. And that was $904,200. So that takes the old equipment off the books. We paid cash of $587,000. So that's pretty straightforward. We need to put the new equipment on the books. Has a value of $1 million. And that $1 million looks like it's made up of the $587,000 and the $413,000. So that new equipment goes on the books for $1 million. And I don't think I'm missing anything. So at this point, let's see what we're missing as far as getting us in balance. So we've got $1,456,300 in debits, and $587,000 in a credit, and $904,200 in a credit. So it looks like we need a debit of $34,900. And if it's a debit, it has to be a loss. It'll be a loss on exchange. Let's see if I did my math right. And it looks like I did. So in this one, I took the old equipment off. You have to figure out how much the accumulated depreciation is, but then take the old equipment off along with the depreciation. Put your cash in that you've paid out. Record your new equipment, and then whatever's the difference is either your gain or loss, and that's just a plug number. And I'm guessing that in number 2, it'd be pretty much the same thing. If I were to guess, I'd say they're probably going to give you one with a gain. So that's a hint for what it's worth. All right, let's look at one more. Heath Mining Company acquired a mine in 2019. Capitalized cost $3,400,000. They have mined 130,000 tons of ore, and they estimate that 1,700,000 tons of ore remain. So we're supposed to compute the amount of depletion expense. This one isn't really hard, but I feel like I remember some students having trouble because they're such large numbers. There are issues with rounding. So let's see if we can get through this. So the capitalized costs, $3,400,000, and it looks like the expectation is that we're going to mine 1,700,000 more tons. Plus, we've already mined 130,000. So if we add those two amounts together, I get 1,830,000 tons of ore. So that's the total output that we expect from that mine. We're going to take the capitalized cost and divide it by that amount to get an amount per ton for those costs. So 3,400,000, that's a lot of zeros, dollars, divided by 1,830,000 gives me 1.857923497 whatever And that's where students go off track, because I get like 12 decimals on there. So to figure it, where does it say? Round intermediate calculation of 2 decimal places. So when you come up with that per ton amount, round it to 2 decimal places. So mine's $1.86. It's going to round up. So I have $1.86, and that for 130,000 tons of stuff. So I'm taking 130,000 times $1.86. My depletion looks like 241,800. Let's see if that worked out right. Yeah. So if you don't round that dollar amount, you're probably going to come up with an incorrect answer, because it's really picky. And the numbers are so big, it's easy to get off track. So these are just some examples from Chapter 18. As always, if you have questions, email is the best way to get in touch with me. Send me an email, and I can actually look at your work and see where you've gone off track and try to help you. I hope you have a great week.